Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. Yields are soaring again.
How about it?
Unbelievable. 486 for 20 years. Very interesting stuff. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. Yields, as I say, surge. The U.S. 10-year hits its highest level since 2007. We'll speak with the co-founder of BondBloxx about those high yields and their new high-yield ETF.
And Cathie Wood's big bet on Europe, how ARK's purchase of Rise, I hope I'm pronouncing that correctly, helping them tap into the growing appetite in the region for active ETFs.
And doubling down on sports betting, how investors are cashing in on the growing business of gambling with the Bets ETF.
And Matt, as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Matt, thank you. You talk about high yields rising. Some of that's creeping up into the flows. So first, let's start with some bullish sentiment, which is good, right? I'm a little shocked because market hasn't been great the past couple of weeks. Look at the 1 week. 9.8 billion at SPY. That is really good. That's the trading crowd, followed by the Qs, followed by IWM small caps, and followed by IWF. That's growth. You couldn't really ask for a more bullish top four, but then you got Bill at number 5. That's ultra short-term treasuries. BKLN is interesting. That's senior loans, which have a higher yield, and they float, which I get the logic of that. HYG, RSP. So again, you got a lot of pretty good bullish sentiment here. It's not all good news. Let's look at the outflows. And at the top of the list of the outflows, you see a bomb out of IVV. To me, I think this is BlackRock's model, if not Merrill's. Those are the two companies that own enough to rotate that big out of that. So potentially they're taking some money off the table or they're a little scared. Probably not a good sign. Those Vanguard funds, that's tax related, so it's not sentiment. I'm going to ignore those. And then money out of JNK, which kind of offsets the HYG. So there is some bearishness to offset the bullishness. Now I want to talk about the Treasury ETFs because there's an interesting thing going on. We talk about these yields going up. TLT is the second biggest inflow ETF of the year, but it's gotten clobbered. It's the only one in the top 10 with a negative return. But investors have kept piling in, but they're starting to go away. I think they're kind of surrendering to a degree. So if you look here, the white line is ultra short. Ultra short had been outflowed by long-dated treasuries all year, right? But the last 2 months, ultra short takes in the most, followed by intermediary, long-term. Same this month. That's 2 straight months of this trade petering out, people going into ultra short. Why? Because you still get that juicy yield, but without the pain of treasury, the long-dated part of the curve going down again and again.
But you have reinvestment risk. And also, if you're betting on a recession, I would think you want to move out the curve. Let's ask somebody who knows more about this than me. Joanna Gallegos joins us, Chief Operating Officer and co-founder at BondBloxx. It's the first ETF provider solely focused on fixed income, and you cut the industry, the asset class, into slices so people can pick and choose. I've been hearing a lot more people say they're going out the curve. They want more duration because they're worried about all the headwinds facing the economy. What are you seeing?
Yeah, so you will see, as Eric mentioned, that the top flow into the Treasury segment has been on the long end of the curve, but that trade has been getting clobbered over the last 3 months. And I think that's just a bet on the way people thought that the Fed would pivot and change, and it hasn't come to bear in 2023. It didn't happen in 2022. At BondBloxx, we don't foresee a recession happening in 2023 or even mostly into 2024. So that may not be where your best allocation is in fixed income right now. We think, importantly, you should be thinking about adding as much quality risk in fixed income into your portfolio so you can achieve, longer term returns that people were trying to do with equities for the last 10 years in a much less risky way.
So to boil that down, are you saying it's better right now to take credit risk rather than duration risk?
We're definitely telling people, and a lot of our products manage duration for that very reason. Like, get every fixed income portfolio manager, Joanne Bianco at our firm will tell you that's the one thing over 30 years she did, is manage the duration out of her portfolios and looked for the quality risk and looked how to add it smartly. So it's not about making a bet of bringing risk on or bringing risk off. It's about making sure you're understanding how interest rate risk is really persistent in your portfolio right now. But when you look at credit risk right now, you look at corporates and specifically in high yield, you're coming, not only did we start 2023 from a position of strength, but that resiliency and strength in the balance sheet has endured and looks like, you mentioned refinancing risk, it looks like into 2023 and 2024, you're not going to see a spike in defaults. And you're going to see companies weather this through because their balance sheets, their interest rate coverage is incredibly strong. It's a very, very different place to be this late in the cycle than others had before them.
So I get this. You know, I always bring up XCCC,
yeah,
which is the most junk bond, junk ETF that you can ever find, almost 100% in all junk bond ETFs, triple C rated.
Yeah.
It's the second best performing fixed income ETF of the year out of 600.
Yeah.
But the flows just aren't there. Why aren't people jumping at something that's up 12%, yielding 12%?
I think people need to remember the fundamentals and the characteristics of fixed income. They're forgetting this. They haven't looked at the asset class for a long time. One of the reasons Triple C is performing so well is because it has a very high coupon. And when rates are now double what they were before the Fed started raising rates, what that does is it provides an immense amount of cushion in your portfolio. And so when you're looking at these rates and this coupon income, we looked at high yield, and for the last 10 and 20 years on an annualized basis, it's the coupon income that was really driving the returns in these fixed income instruments. And so you're right, people need to familiarize themselves with the characteristics of something even as interesting as Triple C. You couldn't trade the category, you couldn't trade the exposure before BondBloxx launched this fund, and now you can see it and you can interact with it. And I think the important thing to remember about Triple C is it's not, you know, if you're thinking about adding more equities to your portfolio right now, you're taking on whatever the volatility of the equity market is. You just put up some interesting stats. But if you look at fixed income and you look at Triple C, you're getting, you know, especially in broad-based high yield, you're getting half the volatility as you are of the S&P 500. Yet you're getting a lot of yield and a lot of return because that's what's driving your
I always hear fixed income people say there's not enough yield. Spreads are too tight, right, to take that risk. And if we're looking at a situation where the consumer has no more savings, putting everything on credit cards, delinquencies are rising, gas prices are high, strikes are going on, government shutdowns, wouldn't you expect defaults to start kicking up?
Well, actually, the defaults are not expected to spike over long-term averages, which in high yield is, you know, on average, like long-term fixed income defaults are around 4 or 5%. So we're not expecting it to do that. It hasn't done that yet. There are all those factors, but there's still resiliency and strength through even what we see. There's strength in the consumer. There's strength in balance sheets of corporations. Where you want to really think about is like this started in 2022. Mm-hmm. We're nearing 2023. It's not expected the Fed's going to do a huge pivot in 2024. So are you going to look for the next 2 years and look away from these yields in fixed income, which are clearly higher for longer, as of last week? And so it's just sort of not a FOMO trade here, which is one of Eric's favorite topics, but it's more of reminding yourself of how fixed income works in your portfolio. And now you can dial it up or dial it down with BondBloxx.
Well, on the topic of high yield, let's talk about a product that you just launched. We're talking about the BondBloxx USD High Yield Sector Rotation ETF. The ticker there is HYSA. And this is interesting because it's an ETF that holds your sector-specific high yield funds. Talk to us a little bit about, out of the gate, what does the allocation look like and how often you think this ETF will turn over? Yeah, so one of the first things that people said about our product suite of the high yield sectors is like, what do I do? How do I put them together? And so we responded to that feedback with clients, and we worked with Macquarie Asset Management to launch this fund. And so if you want to think of it sort of as almost a way to replicate your broad-based ETF exposure in high yield, but with a little more intention around how to underweight and overweight some of these sectors as we're going through this cycle. So you wouldn't be surprised right now that energy is overweight, industrials are overweight, non-discretionary consumer is overweight. And so you're able to sort of like see some of the trends that are going on with companies through this period reflect your current market. And that's, I think, what people wanted to hear. They recognize that we were saying there's dispersion among the sectors and there's opportunity amongst the sectors, but it can be very hard to put that together. So we worked with, you know, an active asset manager in Macquarie Asset Management, and they're helping us manage this fund. And that's what HYSA is. It's how do you invest in high yield right now.
All right, very interesting stuff, Joanna. Thanks so much for coming in the studio. Joanna Gallegos, she is one of the founders of BondBloxx and talking to us here in our New York headquarters. Coming up, ARK is betting big on Europe with the new ETF acquisition. We'll dive into the details next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a risk parity ETF. We're taking a look at ticker RPAR right now. We know that this twin sell-off that we've seen in stocks and bonds has really hammered the 60-40 portfolio. It hasn't been too good for risk parity strategies as well. This ETF last week sank to its lowest level in almost a year since last November. We'll see how low that line can go. But let's also talk about muni bonds, because those higher yields that we're talking about, at least in the muni market, starting to attract some buyers. You're taking a look at ETF MUB right now. It saw its largest weekly inflow since May 2022 last week. So clearly, at least in the muni market, some bond buyers looking to buy the dip. But let's also talk about Europe, Matt. I know it's near and dear to your heart. You're going to take a look now at assets in the European ETF market. As you can see, it's been a pretty steady march higher over the last decade or so. And that steady march higher, that growth opportunity that could exist in Europe, is one of the big reasons why we saw Cathie Wood last week actually come out with some rare M&A news. She's buying asset manager Rise.
Because there's good growth over there. I mean, we always talk about how big the ETF industry is, and I think it's important to look at it globally. If I go onto ETF Go, I have to X out equities, X out United States, and then
Home bias is real, Matt.
10.3 trillion in assets in the class, 17 trillion in fund assets. All right, let's talk about this more with Rebecca Sin, ETF analyst at Bloomberg Intelligence. She joins us live from Hong Kong. Rebecca, what is the growth like in terms of, I feel like Eric and Katie ignore the rest of the world. So it's great to have you here. What's the growth like in terms of, you know, in comparison to the US, if you look at Europe, if you look at Asia?
So first, I'd like to give a shout out to Matt. You always mention Asia. I know that, ETF IQ is very US centric, but if we look at the growth and compare Asia Pacific and Europe ex-USA, Asia Pacific is currently at $1.3 trillion. Europe is at $1.5 trillion. But we believe that Asia Pacific may soon surpass Europe because there's so much growth coming out of Asia Pacific. If we look at the Asia Pacific region, Bank of Japan leads with assets under management. Japan has surpassed 500 billion in assets under management, and mainland China is closely second with more than 300 billion in assets. And so there's tremendous growth coming out of Europe and Asia Pacific.
Rebecca, you'll have to forgive me. I was born in New Jersey. I live in New York. I'm pretty US centric, but so a lot of growth in Asia. But talk to us a little bit about the European market and what Cathie Wood might see there.
So Cathie has just acquired Rise ETF. It's a European ETF issuer that has roughly 450 million in assets under management. They are a boutique ETF issuer with only 11 ETF that focuses on sustainability, cybersecurity, digital payments, and they even have a pet care ETF. Their largest ETF is the Rise Sustainable Future of Food with roughly 180 million. But this acquisition ultimately provides GARC a global product offering now. So they have Europe with Rise, and they have Nikko Asset Management in Asia Pacific. And so there's very few boutique ETF issuers that do have a global distribution. So now this completes Cathie's global take. But I think where the growth prospect is in Europe is ultimately active management. So if we look at active managed ETF, there's roughly 600 billion currently, but we estimate that this could rise as much as 750 billion by year end. And ultimately, a lot of this growth is going to come out of Asia.
I was going to ask about that. One of our BI nerds wrote a story about JEPQ being boomer candy. And I thought it was, well, first of all, what a fantastic turn of phrase. But also, active really is a game changer, isn't it, Rebecca?
Yeah, so active management has really picked up, especially in Asia Pacific. Japan just launched their first actively managed ETFs earlier this month. And if we look at all new actively managed funds and new launches across the region, in Asia Pacific, 20% of new launches came from actively managed fund. And so in terms of where we think the growth is, we think that ARK could get as much as 20 billion in assets under management in the coming years because there's so much demand for actively managed funds. So to give you an idea, Asian investors would oftentimes prefer to buy a UCITS fund for the tax benefits, and the tax savings can be as much as 50 basis points to 2%. And so there's huge demand for actively managed funds. And in Asia, a lot of clients are starting to launch feeder funds or even funds of funds, and they often prefer to have a UCITS option as opposed to the US for tax purposes. And one idea that you may not know is, for instance, Cathie Wood is very loved in Asia, and she has several nicknames. So for instance, in South Korea, her nickname is Money Tree. And so oftentimes her translated name means money tree. So there's money falling off the tree. In China, her name is Mu Tao Jie, which means wood sister. So people consider her a family and they view her as a sister. And so in terms of growth, ARK may kickstart the actively managed space in Europe.
Rebecca, that's so funny because they actually call me Money Tree as well. It's really interesting. Rebecca, really appreciate you staying up late for us. That is Rebecca Sin of Bloomberg Intelligence joining us from Hong Kong. Now, still ahead on ETF IQ, Ed Rosenberg, head of ETFs and funds management at Texas Capital, joining us next on his new ETF. That's next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller, alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence. Back with us now for today's drill down, where we focus on one ETF. Eric, take it away.
Katie, today we got a fun one. Texas, where I used to live. I actually grew up in Texas. Some people don't know that, but great place to grow up. Texas Capital Texas Equity ETF. TXS is the ticker. It's simple. It invests in companies headquartered in Texas. So if you look at this, it's not active, though. It's not actively managed. The fee is 49 basis points, has a little bit of a quantitative design in the index, but basically, if we look at the holdings, you can see what we're going to get. These are companies that are based there. It's going to open up with Tesla. We got Schwab in there, Waste Management, Exxon. These are some heavy hitters in here, Oracle, GameStop. So you're going to be overweight energy, which isn't a surprise, and underweight tech. That means it's going to have a lower valuation than other ETFs. Let's look at this versus the S&P. It's relatively new, so I don't really want to compare it. These things they move pretty closely together. But again, this one's down a little bit because the tech has had a nice run this year so far. This is the kind of ETF that, because it is overweight value and energy, when that comes back, this should outperform, and it will probably get some looks from people, including those who are residents of Texas, Katie.
Eric, thank you. And joining us now to talk about this ETF is Ed Rosenberg. He is head of ETFs and funds management over at Texas Capital. Ed, I'm so excited that you're here because state-specific funds, we don't really see a lot of them. And to Eric's point, what's the pitch for people who don't live in Texas to buy this ETF?
Well, I mean, if you think about what Texas is, right, the economy itself in Texas is growing faster than any other state and faster than the U.S. as well. It's the 9th largest economy in the world, and I believe when the new numbers come out, we may jump ahead of Italy and be the 8th. So Texas is growing extremely fast. Cost of living there for individuals is way cheaper than, say, for example, like New York or LA. So by doing that, you're attracting talent, and the other benefit is, as a resident, I don't pay taxes, but neither do companies. So you're seeing a flock of companies move to Texas to take advantage of that, which can add to the bottom line and create more growth for those companies in the long run.
I mean, it seems to me it's a theme, right? You could have an ETF that's actually Texas and Florida, and you could have an ETF that's short California and like Chicago, right? Because this is kind of the national zeitgeist, right? Everyone who's angry about taxes and regulation and like wokeness is moving to these states like Texas.
Leave out wokeness for a second. Think about the companies, though, that are moving there, right? Tesla, I mean, I don't know if they were angry about wokeness, but when they left California.
Elon Musk definitely is not down with woke.
He's not, but he's also probably not down with paying 12, 13, 14% in taxes to the state. So it's more about that aspect. When you think about what Texas offers, there's a ton of colleges, there's a ton of talent. We're in New York today, it's raining, right? It's sunny in Dallas, right? And there's a ton of days of sun that people want to experience. It does. My joke is it's sunny or you have to run because the rain's coming hard and it's a heavy storm. But realistically, Florida's not experiencing the same growth. They're experiencing influx of people, but not the same growth in industries that the state of Texas is. And so as Texas continues to grow, I mean, let's leave out Tesla for a second. I mean, I never thought Caterpillar would leave Illinois. They left Illinois. The state tax there is 5%, but they still left and moved their headquarters. Schwab has been, what, in California forever? They left and moved. There's a ton of companies like that.
Yeah, but you've been around. We know there was a Texas ETF before this one, and it liquidated. There was an Oklahoma ETF and a Nashville ETF, and they all, are not with us any longer. Why will you make it and when those failed?
It's a good question. I mean, think about how this one's set up. This is GDP weighted. It's not market cap weighted. What we're looking for is GDP weighted by sector. So you're getting the impact of each sector on the state's economy. So while there's 216 companies, 71 of those, a third of those companies are energy, right? But you wouldn't expect energy to only make up 23, 24% of the index. You would actually expect it to be like 45 if you market cap weighted it. But when you really dig into the impact on GDP, that's the difference. And from the advisors we've talked to, that GDP weighting is resonating really well. And by the way, it's not just in the state of Texas. I mean, I just spent a week in California talking to advisors, and it resonated really well with them.
Ed, thanks very much. Next time, wear cowboy boots. Ed Rosenberg of Texas Capital. Before we go, here's a special look at another ETF. This one is on gambling. Football season is kicked off in the U.S., and investors are hoping to cash in with the Round Hill Sports and iGaming ETF, known by the ticker BETZ, BETS. This fund provides exposure to companies that operate in-person or online sports books, gambling platforms, as well as the ones that provide infrastructure and technology needed to run the operations. The first 6 months of this year saw U.S. commercial sports betting on a record-setting pace, with year-to-date totals reaching more than $5 billion, up 66% from the same period last year. These numbers are being driven by more than 30 U.S. states that now have live, legalized sports betting, which is good news for the BETS ETF, since it has around 40 holdings mainly based in the U.S., with some exposure to Australia and the UK. In BETS, you can find expected names like DraftKings, Caesars Entertainment, Churchill Downs, MGM, Penn Entertainment, and Boyd Gaming. Since its inception in June of 2020, the ETF has posted positive returns, but easily has trailed the S&P 500. The fund has about $100 million in assets, comes with an expense ratio of 75 basis points, and gets a green light from the Bloomberg Intelligence traffic light system with one warning for its alternative weighting. And that does it for Bloomberg ETF IQ. This is Bloomberg.